There's a quiet shift happening in the background of the global financial system. No alarms, no breaking news banners, just numbers moving slowly, month after month. China, for years one of the largest holders of U.S. government debt, has been steadily reducing its exposure. At the same time, it's been buying more gold. Not dramatically, not all at once, but consistently. And that raises a question worth sitting with. Why would the world's second largest economy slowly step back from U.S. Treasuries, the very asset once considered the safest place to park money, and increase its gold reserves instead? Is this a warning sign for the dollar? A geopolitical message, or simply a cautious financial decision in an uncertain world? Tonight, we're not here to jump to conclusions. We're here to understand what's actually happening and what most people are missing when they talk about it. Because this story isn't really about China, and it isn't really about gold. It's about trust, and how quietly, slowly, that trust is being redistributed. To understand why this matters, we need to rewind. For decades, U.S. Treasuries were the backbone of global finance. They weren't just bonds, they were a promise that the U.S. government would always pay its debts, a promise backed by the world's largest economy, its military power, and its role at the center of global trade. China became a major buyer for a simple reason. It sold massive amounts of goods to the United States. Those dollars had to go somewhere, so China recycled them back into U.S. debt. This arrangement benefited both sides. The U.S. could borrow cheaply. China could keep its currency stable and its export machine running. For years, this system worked. But the world changed. Trade tensions grew. Sanctions became a policy tool, supply chains were disrupted, and geopolitical trust, once assumed, became conditional. At the same time, the U.S. began borrowing more aggressively. Debt levels rose. Political standoffs over spending became regular events. None of this caused an immediate crisis, but it changed the atmosphere. And in finance, atmosphere matters, because long before money moves quickly, it starts moving carefully. Online, the reaction to China's treasury sales has been loud. Some headlines frame it as a financial war. Others say China is preparing to collapse the dollar. Some claim this is proof that the U.S. economy is about to fall apart. You'll hear phrases like dumping, abandoning, or escaping the dollar system. And it's understandable why people feel uneasy. Gold has always carried emotional weight. It represents safety, independence, something solid in a world that feels increasingly fragile. So when China buys gold, people read into it. They assume intention, strategy, even confrontation. But here's the problem. Most of these narratives compress a slow, complex process into a dramatic storyline. They skip the context, they ignore the pace, and they turn cautious adjustments into existential threats. The truth is quieter than the headlines, and more interesting. Let's slow this down. China is not selling U.S. treasuries all at once. It's reducing its holdings gradually. And even after these reductions, it still holds a significant amount of U.S. debt. This is not an exit. It's a rebalancing. Think of it like a household adjusting its savings, not because the bank is about to fail, but because relying too heavily on one place feels unnecessary. At the same time, China has been increasing its gold reserves, again, steadily, not aggressively. Gold plays a unique role for central banks. It has no counterparty risk. It isn't controlled by another government. It doesn't depend on payment systems or sanctions. Gold doesn't generate income, but it doesn't need permission either. For China, this matters. Over the past decade, the world has seen how financial systems can be weaponized, assets can be frozen, access can be restricted, reserves can become political tools. From a risk management perspective, holding a mix of assets is simply prudent. This isn't ideological, it's structural. China isn't saying the dollar is finished, it's saying dependence carries risk, and central banks are paid to think about risk before it becomes obvious. Here's the part that often gets overlooked. This isn't just about China. Central banks around the world have been quietly increasing their gold reserves, not because they expect collapse, but because the global system has become more fragmented. The post-Cold War assumption that economic integration would reduce conflict has weakened. In its place, we now have a world where access can change based on politics, where financial neutrality is no longer guaranteed. Gold in that environment becomes less about fear and more about flexibility. Another overlooked detail is scale. The U.S. Treasury market is enormous. China's sales, while noticeable, are not destabilizing it. Domestic investors, pension funds, and other governments continue to buy U.S. debt. The system adjusts. So why does this story feel bigger than it is? Because it touches something psychological. People sense that the old certainties are fading, and gold becomes a symbol for that unease. But symbols aren't outcomes. What we're really watching is a slow transition toward a more multipolar financial world, one where no single asset or currency carries unquestioned dominance. That shift doesn't happen overnight, and it doesn't need a crisis to begin. In the short term, this doesn't change much for everyday life. The dollar remains the world's primary reserve currency. U.S. Treasuries remain deeply liquid. Global trade still runs on the existing system. But over the long term, the direction matters. More diversification means less reliance on any one country, more regional trade, more bilateral agreements, more hedging. This doesn't mean instability. It means adaptation. For the U.S., it's a reminder that trust must be maintained, not assumed. For China, it's a signal that financial independence is a priority. And for the rest of the world, it's a lesson in how quietly power shifts, not through announcements, but through balance sheets. So what should we take away from all this? Not fear, not certainty, and definitely not hype. What we're seeing is a cautious world adjusting to a new reality. China reducing treasuries and buying gold isn't a dramatic break. It's a measured response to a system that feels less predictable than it once did. This isn't the end of the dollar, and it isn't the return of a gold-backed world. It's something more subtle, a slow repricing of trust. And those shifts don't announce themselves. They happen quietly, over years, while most people are looking elsewhere. The most important changes in the global system rarely arrive with noise. They arrive with silence. And by the time they're obvious, they've already been happening for a long time.